Investors. Today we're talking about Crocs. I know quite a few people who are diehard fans of their stock, have a lot of interest in owning shares of this company. They like Crocs, not just because of their all-wheel drive sandals, but because they think it's well run. So I'm just going to go ahead and start diving in. Of course, as always, I do more of a quantitative analysis at the beginning, more numbers, stuff you could find anywhere on the internet, really. And towards the end of the video, I do more of the qualitative, looking at some of the stuff that I find reading through the 10K, the annual report that not a lot of people would catch themselves unless they're reading it, on their own. And so I'm going to dive right in here. Of course, current price is about $95 here, about the end of August in 2023. Price history has been very strong growth. If you bought in 2018, you're doing very well. 31% increase over the last 5 years. Strong ISS governance scores, nice and low, 1 to 10, 10 being the worst. Shareholder rights typically aren't great for newer, younger companies anyways, though they have been around for quite a while. Profit margin, operating margin, very strong numbers. Very strong numbers on all of these other factors in that first set of columns: return on assets, equity, past 5-year growth. Of course, next 5 years, analysts are only predicting 10%, but that's still fair. Operating and levered free cash flow, nice positive numbers there. Sub 10 forward price to earnings ratio. Price to book is 5.5. Again, people are willing to pay a premium for this company because they believe in it. Price to sales is less than 2, which is definitely what you want there. Insider ownership is relatively high at 2.7%. And then, of course, nice solid amount of cash and debt. Cash on hand, though it doesn't quite outweigh the total amount of debt. I usually like to see more cash than debt, but sometimes that's wishful thinking. So of course I try to look at this in 3 different parts. You got working capital, cash being the lifeblood of the company, where's it coming from, and then also ability to work through their current assets. Capitalization, looking at how the company's structured, especially on the financing side. And then of course profitability, looking at how strong the company's operations are. So current ratios decreased by almost 5% over the last 5 years. So not as strong of a position there, but it's been fairly flatlined for the past 4 years. So at least they're consistent. Cash generating power ratio has dropped by almost 15% over the last 5 years. The numbers are pretty weak there. That's cash generated just from operations compared to, say, financing or investing. And so not super strong numbers there. I'd like to dig into that a little more to figure out what's going on. Of course, quick ratio, also a decrease of about 9%. So a little bit of a struggle there. Quick ratio is current ratio, but you take out the inventory from the current assets. So, that seems to weigh a little heavily on it. Of course, over the last couple of years, we've had a little bit of inventory gluts. But when we look at inventory turnover, days inventory, actually pretty good numbers. Sitting around 4. This last year, they bumped it to almost 5.5 times per month. Basically, they go through the ratio, their inventory. So definitely doing well there. 5.4 a year. I apologize. And then days inventory, of course, you want less than 95. Strong numbers there. It's decreasing 6.5% over 5 years, or 4 years, sorry. And so, actually looking very good in the sense that, the inventory that they get, they're turning around and getting it sold, and they're improving those numbers as well over time. Operating cash flow ratio, this is the cash from operations divided by the current liabilities, increased by 8.7% over 5 years. So, definitely strong there. Of course, you'd like to see more than 1. And so sitting around 0.9, jumped to 1.5 in 2021. That's challenging. Of course, something to note here as we're moving into capitalization, they did recently purchase the Hey Dude brand. And so I imagine that had to kind of weigh on the company itself. So something to consider there, of course. Moving into capitalization, of course, debt to equity is not great. Definitely some crazy numbers in there. But again, having to take on a lot of debt, I believe, in order to make that acquisition happen. So, not a huge fan of that. Typically, if you're seeing these high of numbers on the debt to equity, usually you're seeing really high current ratios because they're bringing in a lot of cash to, be able to float the company. So interesting that the current ratio stayed so low. Debt to assets is relatively fair. Not terrible numbers there. Assets to equity, of course, super high numbers here, but even there, it's not terribly concerning. It's just it is increasing over time, and so you definitely don't really want to be seeing that. Tangible book value per share has decreased significantly. Again, they've increased a ton of goodwill on the books because of Hey Dude and that purchase there. So of course that's going to drop that tangible book value, even if the total balance sheet looks fine. Total debt has increased 85% over 5 years. So again, I hate to beat a dead horse, but debt levels have skyrocketed for this company. And then of course, capital expenditure increased by about 50%. So that does tell me, okay, take all of this, those first 5 numbers where we got red and orange, and factored into the fact that this company is investing in itself, the capital expenditure is high. And so it does kind of justify the additional debt they've taken on because they're spending it on growing the business. Now on profitability, this is really kind of one of the big bright spots. I think this definitely is a good reason to be a fan of this company. So of course, earnings per share has increased by 50% over the last 5 years. Really, it's 50% over 4 years. You can't use negative numbers in a compounded annual growth rate, the CAGR. So I can only do it from 2019 to 2022. Revenue, solid 26% growth over 5 years. Gross profits increased by 27%, so decreasing some of their operating expenses as well. Operating margins increased by 30% over 5 years. We had a big dip in 2022, so definitely want to look into that. And then of course, return on assets, return on equity. I put orange there, but they are really doing well on those numbers. And of course, a big factor of it is I had to use normalized net income because net income itself, I believe, was either really weak or negative. And so, of course, something to consider when you're doing your own research here. I don't have a ton on noteworthy, this kind of qualitative section, but this is just some interesting stuff I found in there. So, of course, the company's focus is on growing digital sales. They're focused on expanding their sandal market share, strengthening that Hey Dude brand, continuing to push international expansion, which they already run. About 30% of their operating revenues come from international sales. So definitely very diversified in where their income's coming from. Of course, they note that Hey Dude adds a loafer concept to their key product lines. They focus on clogs, sandals, and then their gibbets charms. So it's kind of funny they included that. I never would have considered that a key part of where their revenues would come from, but I didn't know they were still even selling them. Of course, 6 priority markets: China, India, Japan, South Korea, the US, and Western Europe. As far as manufacturing goes, they are very dependent on Vietnam and China. So if you're studying this company, you also want to kind of know what's going on in those 2 places. They listed out some of their competitors. Of course, it's always interesting to see who they single out. So their primarily listed competitors were Nike, Adidas, Deckers Outdoor Corporation, Skechers, Steve Madden, Wolverine Worldwide, and VF Corporation. So, of course, a lot of people might not have picked those specific ones, but that's who they see themselves competing against. An interesting note, I just went ahead and copied it word for word. So it says, our senior revolving credit facility agreement as amended to date, the revolving credit agreement, the term B Term Loan B credit agreement and the indentures each impose significant operating and financial restrictions on us and certain of our subsidiaries, which may prevent us from capitalizing on business opportunities. So there on the last note I have there, they have a very multifaceted debt structure. Involves revolving credit facilities, and not just in the U.S. or through Libor, but also, they've got revolving credit facilities in multiple countries, like several. So I found that interesting because I don't see that on a lot of companies. And of course, they got senior notes, which is pretty typical, and then Term B loans, which is its own thing. And they note, their financing arrangements create a lot of limitations on their ability to issue dividends. So if you're buying this company hoping they're going to start paying dividends soon because they have, strong earnings per share, it's not going to happen anytime in the near future, but it's certainly possible. Critical audit matters. This is something I really like to look at just because I want to see, how the auditors view the company's reporting. The only two things they noted was the evaluation of deferred tax asset from intellectual property transactions. So not anything crazy there. And then the acquisition of Hey Dude, the valuation, trademark, and customer relationships. You expect to see that as well because, you don't want them putting that as a, necessarily assuming too much of the book value of that company, especially if it needs to be listed as goodwill. And so, they definitely had to dig into that because the internal controls of Hey Dude, as a separate brand and subsidiary and all of those kinds of things, it takes a while to get those matched up with the parent company. And so, of course, that is a challenge for the auditors. Weird note here, fourth quarter of 2022 contained an $85 million error in proceeds from borrowing or repayments to the bank. So, they note the error, they point it out, but, they said it's not material, but $85 million in my mind would be material, but that's just maybe my small mind there because I don't run a giant corporation. And then, of course, I mentioned their multifaceted debt structure. So I apologize if it doesn't seem like I have a lot here, but I was interested. I wasn't, at first I was like, man, I'm not super impressed with Crocs. Like, I know people that just love them to death and, invest and invest and invest. But the more that I dig into it, there are solid explanations for some of the, less positive things. And of course, that's the importance. I know some people, they'll look at 3 ratios and say, oh, I'm going to buy this stock. It's great. Well, you can't base it off of just, price earnings and, the payout ratio and, debt to equity and call it good. Like, no, you need to, it's best that you look at multiple factors because you really want to make sure that you're setting yourself up for success. So definitely, if you're, get out there, dig into this company if it's one you're interested in. As I mentioned, I kind of threw it out there, but, do your own research. Certainly don't take my word for it. Get out there, start reading, maybe read through some of their quarterly reports from 2023 here, because it'll be February next year probably before we get to see their next annual report 10K. So, we're already, at least 3 quarters into this year by September 30th. So, definitely get out there and read some of their more recent stuff. I don't always read the 10Qs, the quarterly reports, because they're not reviewed, they're reviewed by internal staff, but they're not always audited by external auditors. And so I'm an accountant personally. And, if I'm going to trust the financial stuff, especially if a giant corporation with all of these moving parts, I want an external auditor to really verify that for me if I'm making decisions based on those numbers. So again, that's more personal preference. I appreciate you sticking around if you made it this far in the video. As always, leave comments if I messed something up, if I got something wrong. If I said something, that out of place, definitely let me know. I appreciate the feedback. I do try to get back with those as quick as possible. If you have a request for a different company you want to see, definitely throw that out there. I'm always happy to appease those requests. And then as always, like, comment, subscribe. That helps me, and if you subscribe, that helps you to not miss future content, sparking future conversation. So as always, dig in, invest well, and I appreciate you, and I will see you next time.